Welcome back. I hope everyone had a good Thanksgiving. I skipped last week's video to spend time with my family, and then tech stocks decided to go crazy. Instead of our usual opening, let's first talk about what happened with our tech stocks. Check out what happened just on Tuesday after the market closed. So after the market closed on Tuesday, semiconductor company Marvell Technologies reported quarterly results, sending the stock up 23.19% on Wednesday alone. Marvell is in our tech stock portfolio. Also on Tuesday after the market closed, Pure Storage also reported quarterly results that surprised to the upside, sending the stock up 22.06% on the next day, which was Wednesday. Pure Storage is in our tech-themed portfolio, which was started on January 2nd of this year and has a total return so far of 45% this year. Also reporting quarterly earnings on Tuesday was Salesforce. This is, again, after hours. And Salesforce is in our Dividend-Growth stock portfolio and in our tech stock portfolio. Like Marvell and Pure Storage, the quarterly results were better than expected, sending the stock up 10.99% on Wednesday. Last week, the tech stock portfolio as a whole was up 4.63% and up a whopping 11.11% over the last 2 weeks. Our tech-themed portfolio was up 5.99% last week and up 6.63% over the last 2 weeks. The annualized performance for our tech stock portfolio is 68.88% per year, pretty crazy. But since it was started only on April of this year, that number will vary a lot. And the portfolio is very volatile. Even though it had a great week and a great 2 weeks, it also has some really bad weeks too. So it is pretty volatile and not for the faint of heart. Our tech-themed portfolio was started on January 2nd and, as we mentioned, is up 44.97% so far. It's less volatile than the tech stock portfolio. Because these two portfolios are newer, they are not yet on our website, which is beatthestockmarket.com. Subscribers who would like to have them added to the site should let me know. That might be a good project for me over the upcoming Christmas break when I'm not teaching any classes. Now let's get back to our usual opening slide. Our classroom stock portfolio of high-yield, dividend-paying companies now has an annual return of 33.13%, and it's beating the S&P 500 since the portfolio started, even though it has no tech stocks. And our Dividend-Growth stock portfolio has an annual return of 21.87%. It was started, beginning of 2022. So it's been around a lot longer than our high-yield stock portfolio. But our best performing portfolio so far has been our tech stock portfolio, as I mentioned, which is an annualized return of 68.88%. But again, it's only been in existence since April, so it's going to fluctuate up and down a lot with its annualized return. And like in last week's video, or I should say in the last video, which was 2 weeks ago, later in this video I'll discuss ways to potentially boost the return of our stock portfolios, but it will require giving up some portfolio diversification. So what is this slide showing? It's showing the portfolio value over time for our main portfolio, which invests almost exclusively in dividend growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio, and it's now worth over $2,726 after 153 weeks. Each week we take that deposit and split it up to buy 10 different dividend-paying stocks. So we're buying fractional shares of stocks. Each week we re-rate the stocks, so the list of top stocks fluctuates from week to week. And in August of last year, we started a second portfolio, this time investing in high-yield dividend-paying stocks. The tan line on the chart shows what the portfolio value would be if we'd instead put the money into a savings account. In our first year, 2022, stocks didn't do well, and neither did bonds. As you can see, our portfolio had overall losses in 2022, where the blue line falls below the tan savings account line. But the power of compounding is working in our favor as the portfolio really took off in November of 2023. And towards the end of the video, I'll update our tech stock portfolio. And for those who've been asking, I put the Dividend-Growth stock portfolio and the high-yield stock portfolio on our website, which is beatthestockmarket.com. Hi, Professor Rex here. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it gets the attention of my students and keeps them engaged. To show them accounting concepts in action, starting in 2022, we started a class project in which each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 each month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings and investing goals and get ideas of company names that they can do further research on. There are timestamp links in the description of the video in case you just want to jump to the list of stocks we bought last week, or the list of our best performers, or any other section of the video. In 2022, the year we started the portfolio, the market did not perform well, but because I don't believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then, as I mentioned, in 2023, stocks took off. Currently, the portfolio's value is over $2,726. The return has been 21.87% per year. Last year, the portfolio's return was 28.6%, which beat the S&P 500. And in the preceding year, the portfolio once again beat the market. Before we get into which stocks we bought this week, a lot of people have been asking me for my favorite books about investing. My two favorite books were the basis for the 3 stock screens I publish monthly on our website, which you can see over here on the slide. My favorite investment book is called What Works on Wall Street by Jim O'Shaughnessy, whose investment firm managed over $6.4 billion of investments when he retired. The book is the basis of 2 of the 3 stock screens I publish on our website. They're called the Trending Value Stock Screen and Consumer Staples Stock Screens, and you can see their annual performance according to the book. So what is a stock screen? It's a set of criteria used to narrow down a large list of stocks to a much smaller list of stocks in which you can either invest or do further analysis of them to see if you can whittle them down to even fewer. The book examines various ways to tell if a stock is undervalued by examining simple metrics like the price-to-earnings ratio, the PE ratio, dividend yield, etc., as well as combinations of those simple metrics. There are a lot of tables and graphs, so if you're a numbers geek like me, you'll probably like the book. It also talks a lot about the history of the stock market and the psychology of investing, which is also fascinating. The other book I recommend, especially for younger investors, was written by the son of the author I just mentioned. It's called Millennial Money and is the basis for the Millennial Money stock screen that we publish monthly on our website. And by the way, these stock screens were published last Friday. Of course, you can follow the book and just recreate the screen on your own to save yourself some money. It's a much shorter book than What Works on Wall Street. I'll try to put links to the 2 books in the description of the video in case you want to check them out. Also, check to see if they're at your local library. Another way to save some money. Since we're now in the month of December, let's take a look at the historical stock performance in the month of December. According to the Center for Financial Research and Analysis, December sees the largest average stock gain of all the months of the year since World War II. It also has the highest percentage of gains of all the months of the year. And it also has the lowest volatility of all the months, with nearly 40% less volatility on average. So basically, December is historically the best month of the year for stocks. The Center for Financial Research and Analysis also had a list of the best performing sub-industries in the month of December since 1990, and they are home building, healthcare facilities, building products, home improvement retail, and hotels, resorts, and cruise lines. In market news, last Friday's employment report came in slightly better than expected and was an improvement over October's jobs report. This leads many to believe that the Federal Reserve will cut rates again at their mid-December meeting, which is a good thing. Next week, we'll get 2 reports about inflation. On Wednesday, the Consumer Price Index report comes out, and then on Thursday, the Producer Price Index report comes out. The inflation news that these will bring could affect rate cuts in 2025. So they are 2 important reports. Also on Thursday, Broadcom will announce their eagerly anticipated quarterly report. I'm going to predict that the company will raise their dividend yet again. Because we're investing additional funds each week into most of our model portfolios, the way to calculate portfolio performance becomes a bit more complicated. The formula that is most commonly used to calculate portfolio performance is called XIRR, or Extended Internal Rate of Return, and we use it too. It's the same formula used to calculate portfolio performance in Quicken, the popular personal finance software. You can see the formula at the bottom of the screen. You can calculate it by hand, but if you want to maintain your sanity, you are better off using Excel to calculate it for you, and then use Quicken software to double check it, which is what we do. Now in this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows a portfolio comparison when both portfolios existed. The high yield portfolio was started in August of 2023, and the annualized return so far is 33.13%, which is surprisingly higher than our dividend growth portfolio, which is an annualized return of 24.02% over the same time period and includes way more growth stocks than the high yield portfolio. I would expect that the dividend growth portfolio would have the higher return over the long run, especially since the high yield portfolio has 0 tech stocks so far, but time will tell. If an investor was solely investing in the high yield portfolio, I would think about supplementing it with some tech stocks for additional diversification. On our website, we have ideas for technology-focused investments that can provide income, ranging from dividend growth stocks to closed-end funds and ETFs. Now remember, the high-yield portfolio has only existed for nearly 15 months, so its annual return will likely jump up or down to a greater extent than our dividend growth portfolio's return. The fact that the high-yield portfolio is outperforming our dividend growth portfolio over the same time period is pretty surprising to me. I keep expecting the high yield portfolio to come back down to earth, and so far it hasn't. Now this slide shows the cumulative growth of the dividends we've received in our dividend growth stock portfolio. Our dividends for the latest month increased 53% over the same month a year ago, and our dividends for the latest quarter increased 130% over the same quarter a year ago. The graph shows how quickly the dividends are growing and is a great example of the power of compound growth. Now, Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. So why do we only invest in dividend-paying stocks in our 2 main portfolios? The first reason we stick with dividend-paying stocks for our dividend strategies is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for our non-dividend-paying stocks, average return has been much lower at 4.27%. The study is updated each year and was recently updated to include last year, so go check out the source link that I included at the bottom of the screen. Now, our best performing portfolio, as we mentioned before, is our tech stock portfolio. So you might think, well, the tech stocks, they don't pay dividends. Well, it turns out about 8 of the 10 tech stocks that we buy each week on average are dividend payers. Morningstar also recently released a report that went all the way back to 1927. It came up with the same conclusion, the conclusion being that dividend-paying stocks have a higher return and less volatility than non-dividend paying stocks. That second point about having less volatility is probably even more important than the fact that dividend paying stocks have a higher return. Why is the lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely we are to panic and sell at the wrong time. So why are dividend paying stocks less volatile on average? Because most dividend paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our Classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently. Also along the same lines, BlackRock recently released a report showing that $10,000 invested in Dividend-Growers, that's a company that increases their dividend, and Dividend Initiators, that's a company that starts to pay a dividend for the first time, grew to $2.6 million versus $1.6 million for the S&P 500, a difference of 62.5%. Now, the S&P 500 includes non-dividend payers and dividend payers. So a better comparison is to compare it to just non-dividend payers. So that same $10,000 invested into non-dividend paying stocks only grew to $1.2 million. So stocks that raised their dividends or started paying a dividend beat the stocks that did not pay dividends by 116.7%. Now, the holy grail of dividend investing is having a stock portfolio that produces 2 things. 1, a growing stream of income that produces enough cash or enough income to cover your expenses plus extra cash to cover travel, vacations, luxury purchases, etc. And 2, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. So here are two examples of stocks growing their dividend payouts over the years. The first is Broadcom. I bought Broadcom, a chip maker, in 2020, just 4 years ago, for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I invested in the stock, I would receive $5.01 every year. The company has quickly grown the dividend to the point where the yield, now based on the original investment, is 8.21%. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividend, hopefully next week, well into the future. And if not, that's why we have constructed a diversified portfolio. This is the power of investing in a quality dividend growth company. My second example of a high quality company with a history of raising its dividend is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time, and Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I invested in the stock, I would receive only 83 cents a year. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield, based on the original investment, is now 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly won't find a bond that pays anywhere close to yields on the original investment that these two stocks are paying. And bonds do not increase your payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $126,700 of tax-free income each year if you are married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses, but grows over time. And if you're married and filing jointly, you can make up to $126,700 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. This is perfect for retirees. If you're single, that amount is $63,350. Those amounts usually increase each year as the standard deduction increases and the tax brackets are adjusted. And in fact, they just did get adjusted in November. So these numbers are brand new if it's been a while since you saw one of my videos. So how are these amounts calculated? First, you find the 0% tax bracket for long-term capital gains, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, for 2025, the standard deduction increased in November, meaning that you can potentially earn even more tax-free income from qualified dividends than you could in 2024. And then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $126,700 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why did we choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck? I personally am investing a lot more than that in these dividend strategies, but for our classroom model portfolios, the main reason we started with a low weekly investment amount was because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account now, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, when we started this model class portfolio, I invested $25 per paycheck, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation each year. By the way, I also invest in these same stocks, as I mentioned before, in my retirement account and my taxable brokerage account. The research we discussed in the class is the same as the research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents per week for a total of $12.09 instead of the original $11.74. For our classroom Dividend-Growth stock portfolio in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. That's because inflation was high that year. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. Now, a very popular exchange-traded fund that only holds dividend stocks is the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our two dividend-paying stock portfolios. As of today, our Dividend-Gro classroom stock portfolio's annual return is 21.87%. If we had instead invested the same exact amounts into SCHD on the same exact days, the portfolio's return would be only 12.35%, a difference of 77%. Our high yield portfolio is also outperforming SCHD, but by an even larger amount. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our two dividend-paying classroom stock portfolios. I also prefer the actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has at times had large positions in stocks I consider to be value traps. Now this slide shows our best performing stocks based on when they were initially purchased. This includes all 4 of our portfolios, but as you can see in the upper right, the Dividend-Growth stock portfolio was started much earlier than our other portfolios, which means the stocks in the portfolio have had much more time to see their prices rise. Therefore, this list of best performing stocks thus far will be dominated by our Dividend-Growth stock portfolio, at least for the time being. For example, our tech stock portfolio has been our best performing portfolio on an annual basis so far, but because it has only existed since April of this year, only one of that portfolio stocks has made the list so far, that being Shopify. Shopify's at number 9 with 102%. Basically, it's doubled in a little over 6 months. Of our two dividend portfolios, our best performing portfolio thus far on a per year basis is the high yield portfolio. But it only has one stock on the list so far because the portfolio was started 20 months after the Dividend-Growth portfolio. It also holds far fewer stocks in our Dividend-Growth portfolio. So the only high yield stock on the list is Tapestry. Came in at number 14, had basically a 90% gain in 13 months. And stocks in yellow have been sold. So we sold Tapestry. So our best performing stock so far has been Evercore, which we sold recently. It provided us with a 252.9% return in a little over 2 years. Broadcom, a chip maker, remains at number 2 with a 223.3% total return since its initial purchase. The fastest risers that are still in the portfolios are NVIDIA in our technology-themed portfolio with a total return of 195.9%. in 11 months, Shopify, which has doubled in 6 months, which we mentioned before, and Bank of New York Mellon with a 96.7% return in less than 14 months. And remember that total return includes dividends. So this slide shows our best performing dividend stocks last week for our Dividend-Growth portfolio. It does not include dividends. The best performers last week were Broadcom at 10.8%, Taiwan Semiconductor 9.9%, Salesforce 9.7%, Meta 8.6%, and Build-A-Bear Workshop keeps chugging along, had an 8% gain. Microsoft is also in there, one of my favorites. This slide shows our best performing stocks in our tech stock portfolio last week. The best performers were Marvell Technologies at a whopping 22.5%, Broadcom again 10.8%, Taiwan Semi at 9.9%, Salesforce 9.7%, Adobe 7.2%. And this slide shows our best performing stocks in our tech-themed portfolio last week. The best performers were Pure Storage, 22.5, Cloudflare at 13.2, Broadcom again, Viva Systems 9.9, Salesforce, and then Amazon at 9.2%. Before you look at the 10 stocks we bought this week, here are the dividend-paying stocks we bought a year ago, along with their total returns, which of course includes dividends. Stocks in yellow, like NiSource and Hasbro, have been sold. On the left side of the screen, they're dividend-growth stocks we bought a year ago. Bank of New York Mellon has been the best performer so far. Oh wait, not Bank of New York Mellon. I forgot to update that. It's Broadcom at a 96.4% was the best, followed by Morgan Stanley. The average return of the 10 dividend growth stocks we bought a year ago is 28.56%. And on the right side of the screen are the 8 purchases we made for our high yield stock portfolio. It utilizes 2 different strategies, and the strategies often overlap, meaning we often make 2 purchases of the same stock. As you can see, we bought Morgan Stanley twice for the portfolio, one for each of the 2 strategies. The average return of the high yield stock purchases we bought a year ago is 28.47%, despite 2 of the purchases not being held the full year, that being NiSource and Hasbro. The annualized return for all of the high yield purchases was 32.83%. Obviously, our purchases will not continue that high of a rate of return. So here's the usual disclaimer. This presentation is for informational purposes only. It is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others online or anywhere else, but you always need to do your own research. On Monday, last Monday, we sold 2 stocks. We sold Raymond James Financial, ticker RJF, for a total return of 57.1% in 4 months. That's an annualized return of 289.3%. We sold because the stock looks to be fairly valued after such a big run-up in a short time. Plus, the stock's 4-way rating of valuation, quality, past dividend growth, and future dividend growth potential has fallen out of the top 50% of stocks. And at the bottom of the slide, you can see that for our tech stock portfolio, we sold Zscaler on Monday for a 20.5% gain over 2.5 months, which is an annualized return of 140.1%. We sold it because the stock appears to be fairly valued, and its 2-way rating of valuation and quality, now we don't have the dividend ratings because it does not pay a dividend, that 2-way rating fell to nearly the bottom 40% of all companies. Our timing was great, if not lucky, because after the market closed on Monday, the company announced their latest quarterly results, and the stock fell over 8% in after-hours trading. So we are either smart or just blindly lucky there. Now let's talk about the dividend growth stocks we bought last Monday. Here are our ratings for the top 15 dividend growth stocks this past week. But remember, we only buy the top 10. We purchased the first 10 stocks on the list that are not in the yellow highlight. Stocks in the yellow, that being Microsoft this week, have already grown to be 4% or more of the portfolio, so we do not invest more in Microsoft this week because we want to build a more diversified, less risky portfolio. Lam Research and Thermo Fisher remain at the top. Remember, we use many criteria to filter stocks, and if they are hovering at the required level, if a certain metric is hovering around a required level, the stock can make the list one week and then drop off the list based on a small movement. Examples of criteria used to filter out stocks include required margin of safety and consensus earnings growth estimates over the next 12 months, which changes frequently. For consensus earnings growth estimates, I will only purchase a stock for this portfolio if its earnings are forecast to grow at least 5% over the next 12 months. That's because we want to invest in stocks that can continue to increase their dividends. So a stock might have a 5.2% estimate one week and make the list, but the next week its estimate could dip to 4.9%, which means that the stock suddenly doesn't make the list at all. This is just one of many filtering criteria we use to narrow down our list of investable stocks. Each week we buy 10 stocks, and since we're investing such a small amount each week, it means we are buying fractional shares in a Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we are buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks that we were purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we are purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. This table on this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks last week appeared to be Monolithic Power, Nike, Lam Research, and Thermo Fisher. Remember, all of these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they're likely to continue to raise their dividends. Therefore, this is a dividend growth strategy. Now remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage account to make tracking this portfolio easier. So my other brokerage accounts, I'm also investing in these dividend growth stocks and the high yield stocks and the tech stocks in this tech stock portfolio. This week I purchased over $2,900 of the stocks from those three portfolios as I reinvest dividends and gradually transfer out of my main dividend ETF, being SCHD, and I buy these stocks instead. I'm also trying to tweak the buying strategy a bit to see if I can boost returns. I'll share the results with you once I have enough data. Now on this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for the portfolio for 90% or so of our purchases. The other 10% so far has been invested in usually smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown they historically beat the market averages by a significant amount. We did not buy any under-the-radar dividend payers last week. All the stocks we bought last week qualify as high quality and are dividend growth stocks, which means they have a history of substantially raising the dividends that they pay to their shareholders. So risk is the first quality component on this slide, which we mentioned in the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of the reported earnings, also called profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest looking at Microsoft, West Pharmaceuticals, Taiwan Semiconductor, and Nike. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings are Thermo Fisher, Applied Materials, Microsoft, and Intuit. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Lam Research, KLA Tencor, Huntington Ingalls, A.O. Smith, Monolithic Power, and Microchip. All of these earned an A- or better grade. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are Thermo Fisher, Applied Materials, and West Pharmaceuticals. Those earn an A- or better grade. The companies with the best combination of recent dividend increases and potential of future dividend increases are Lam Research, Thermo Fisher, Applied Materials, and KLA Tencor, all having earned an A or B grade for both. Here are our trade confirmations from last Monday for the dividend growth stock portfolio. We took the weekly deposit plus any dividends that had recently been received, plus proceeds from the sale of Raymond James Financial, which we sold, as you can see in green, and then invested the total amount in the top 10 stocks on our buy list for the week, as long as the stock doesn't have a portfolio allocation of 4% or greater, like Microsoft. Sometimes instead of dividing evenly across all 10 stocks, I try to invest a bit more into the higher ranked stocks, but last week I tried to equal weight the investments as evenly as I could. Now let's talk about ways to potentially increase the return of our dividend growth portfolio. For those that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to boost each portfolio's returns. Each week we buy 10 different dividend-paying stocks ranked 1 through 10. Now on average, looking back, it turns out that the stocks in positions 1 through 5 outperform the stocks in positions 6 through 10. Therefore, the first way to potentially boost portfolio returns is to buy only the stocks in positions 1 through 5. Or maybe something like 1 through 6, something like that. However, the downside is this reduces portfolio diversification, but some investors are comfortable with a more concentrated portfolio. So far, investing in stocks ranked just 1 through 5 would have improved annual returns 55%, but I personally prefer a more diversified portfolio since the goal of my dividend portfolio is to live off the dividends. Option number 2, don't limit individual portfolio holdings to 4% of the portfolio's total value. As we mentioned before, normally if a stock's allocation in the portfolio is 4% or greater, I will not purchase more of that stock at the time. This technique reduces the portfolio's risk by ensuring the portfolio does not become heavily weighted in 1 or 2 stocks. I purposely created this portfolio so it would be very diversified because the ultimate goal of dividend investing is to have the dividends cover all of your expenses plus generate extra income for vacation, travels, etc. I'm a conservative investor, and I'm personally investing a lot in these dividend portfolios, so I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio might try removing the 4% limit in an attempt to boost the portfolio's returns, especially if the company is in the top 5 of that week's rankings, as mentioned in bullet point 1. So far, not limiting individual positions to 4% of the portfolio would have improved annual returns by 23.2%. But again, I personally prefer a more diversified portfolio. So to each his own. Number 3, skip the under-the-radar dividend payers. So the under-the-radar dividend-paying stocks in the portfolio, despite having some incredible performers like F&G Annuities 119% gain in 12 months and Repositrax 97% gain in the same time frame, on average, they have not performed quite as well as the dividend-growers in the portfolio. So skipping the under-the-radar dividend payers is an option to try to boost portfolio returns. One possible reason these stocks haven't done quite as well as the dividend-growers is because many of the under-the-radar stocks are very small companies, and small stocks have not performed as well in recent years. Like the previous strategies, this method reduces portfolio diversification. And number 4, sell when a stock is fairly valued, even if dividend and quality metrics are excellent. Now, we don't sell often in the portfolio and tend to only sell if the company cuts a dividend or the stock appears to be overvalued, or the company's dividend and quality metrics fall out of the top 50% of stocks. In other words, if a stock appears to be fairly valued, but the dividend and quality metrics are still good, we usually will not sell the stock just because it's fairly valued. But if you have your own valuation methodology and it signals the stock is fairly valued or even under or overvalued, you might try selling at that time and reinvesting in that week's top 10 stocks or top 5 that we are buying. The downside would be higher turnover, but this could boost your portfolio's return by not holding on to fairly valued stocks. If you try this, I'd be very interested to hear your results. Of course, this 4th strategy is the most difficult to implement because you have to implement your own valuation methodology. And for those looking for a less hands-on approach, let's talk about some options to potentially simplify things. For our model portfolios, we invest weekly, but there is no hard and set rules that says to do that. Most people invest with every paycheck, meaning that most people have funds taken out of their paycheck, which is usually every other week, and it's automatically invested in their 401k. When I started our Dividend-Growth stock portfolio, I originally invested $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. The advantage of investing every week as opposed to every other week or monthly is you get more diversification. Because remember, the stock list changes each week. So if a person does not mind less diversification in their portfolio, option 1 is to invest every other week or monthly instead of weekly. Option 2 is to just buy the high quality stocks, meaning those with a quality rating of B- or better, and hold forever. In other words, don't sell. Over time, some of the stocks will turn out to be clunkers, but they will just be very small parts of your portfolio as you let your winners run. Now remember I said last week we sold Raymond James. I hope we timed that right. However, after we sold it, the company raised their dividend. That kind of sucks, but we'll see if the decision to sell it was good or not. So maybe holding on to Raymond James would have turned out to be better. Who knows? Only time will tell. On this slide, we're looking at our stocks that have raised their dividends recently for our dividend growth portfolio. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher's salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Now, last week, WEC Energy and Eastman Chemicals both announced that they will be increasing their dividends. Oops. On Eastman Chemicals, the date announced is 11/15, I should say 12/6. And as mentioned earlier, we sold Raymond James on Monday for a 57% return in 4 months, which is an annualized return of nearly 290%. But then on Tuesday, the next day, the company announced it's raising its dividend by 11.1%. I hope I didn't sell Raymond James too soon. So the last 22 dividend increases for the portfolio have an average increase of 9.9%. Now let's talk about stock splits. This slide shows stocks in our portfolios that have chosen to split their stocks. Since we keep track of every individual stock in Excel, since we keep track of every individual purchase in Excel, and remember, most of the stocks we purchase more than once, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and the dividends per share that we receive once the stock split has occurred. And this is reminding me that pretty soon I'm going to have to go back and adjust everything for Entergy Company because they're going to split their stock 2-for-1 as of December 13th. Here is a look at the 10 stocks that make up the largest portion of the dividend growth portfolio as of Friday after the market closed. Microsoft shot back up to the first spot as tech stocks had a terrific couple of weeks. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest in one single stock. Aggressive investors might not want to limit the investment into any one stock, but I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's returns would likely be higher if we always invested in our top 10 stocks regardless of the size of the stock's portfolio allocation, but that would create a more concentrated, more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. So our portfolio holdings now are up to 103. So far, around 100 to 105 seems to be the natural limit for the portfolio, as there are only so many quality dividend-paying companies that are trading at a discount. That might seem like a large number of companies to keep track of, but the spreadsheet we have developed for tracking the companies makes it obvious when to sell a company. Once we download company financial and accounting information into the spreadsheet, which we do at least weekly and doesn't take that much time. However, it took a long time, about 2 years, to develop the spreadsheet, and that was a lot of hard work. Now on to the high yield dividend paying stock portfolio. Now I've had several older accounting students who are close to retirement take my classes. They were more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. The portfolio as a whole has had an annual total return of 33.13%. Since the portfolio has been in existence for nearly 16 months, that return will likely fluctuate a lot more than the return of our dividend growth stock portfolio, which was started 20 minutes earlier. Currently, the high yield portfolio's dividend yield is 4.14%, but the companies in it likely will not grow their dividends as much as the stocks in our dividend growth stock portfolio. Therefore, this portfolio would be more geared towards investors closer to retirement. Having said that, many stocks in the portfolio have increased their dividends, pushing the portfolio's yield based on the amount we've invested to 5.05%. Two strategies are being implemented in this portfolio, as you'll see in the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1 in an attempt to try to get the best of both worlds, that being high yield and dividend growth. So far, Strategy 2 has been the better performer. The average investment in Strategy 2 has provided a total return so far 20.01% and has been held for an average of 192.1 days so far, which is an annualized return of 41.43% using Excel's rate function. Now, it's not likely the portfolio can keep up an annual return that high, but like we said before, it's a good start. All right, on this slide, we're looking at the high-yield dividend-paying stocks we bought last week. And because the high-yield stock portfolio currently lacks any technology stocks, for those that want to add diversification to this portfolio, I added to my site a list of technology-focused investments that provide income with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology-focused investments with the higher yields don't have the chance to grow their distribution yields as fast as ones like Microsoft or Broadcom. There's always a trade-off, so don't go crazy for yield all the time. One thing that's different about about this higher yield strategy versus our dividend growth strategy on the previous slides is we only purchase 8 stocks, and we have 2 different strategies within this portfolio. Strategy 1 emphasizes a high dividend yield over dividend growth. That's perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in strategy 1 and 4 stocks in strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Now, having 2 strategies within one portfolio also means that a stock could appear in both strategy 1 and strategy 2. If that's the case, instead of the stock getting a 1/8 weighting, they get 2/8, which is 1/4, and equivalent to 25% of that week's investment. And let's see, as you can see, PepsiCo appeared twice, once in each strategy. So both strategies still only invest in high quality stocks, meaning that with a quality rating of B- or better. The 4 high yield stocks we bought last week while implementing strategy 1 are Bristol Myers, CVS Health, PepsiCo, and GlaxoSmithKline. And the 4 high yield stocks we bought last week while implementing strategy 2 are Gilead Sciences, PepsiCo, Johnson & Johnson, and UPS. Last week's purchases have an average yield of 3.9%, with UPS coming in the highest with a 4.8% yield. And here's a look at last Monday's rating for competitive advantages, management, and financial health. And on this slide, we can see last Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. And the last column, you can see the grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. And here are our trade confirmations from last Monday for the high yield stock portfolio. We took the weekly deposit plus any dividends that had recently been received and then invested them in the 8 stocks on our buy list for the week. We're almost done here. Now let's talk about our 2 technology stock portfolios. Because my students love technology stocks as well as crypto and options, we started 2 technology portfolios just for fun. For the first one, on January 1st of this year, I funded a Fidelity account with $1,000, and we invested it into only stocks offering products or services involved with certain technology themes. Unlike our other portfolios, we are not investing additional funds each week into this portfolio. We're sticking with the original $1,000 investment to see how high we can grow it. Now, the tech themes we built the portfolio around so far are artificial intelligence, cloud computing, software as a service, cybersecurity, and big data. This portfolio can invest in sectors outside the technology sector as long as the company is connected to one or more of our tech themes. For example, both Meta Platforms and Google are in the portfolio, but are both in the communications sector. So far, the portfolio has gained 44.97% in nearly 12 months, a little less than 12 months. I should say a little more than 11 months. In comparison, technology ETF with the ticker symbol XLK is up 25.8% over the same time period, and the S&P 500 is up 29.1% over the same time period. Best performers in the portfolio so far are NVIDIA at 195.9%, Pure Storage, which went crazy the last couple of weeks, Meta Platforms, Fortinet, SAP, Broadcom, and ServiceNow. And let's talk about our tech stock portfolio. Back in late April, we started a portfolio that only invests in stocks that are officially in the technology sector. Like the other portfolios, we invest $12.50 each week into it and then boost that investment annually by the rate of inflation. I hesitate to call this a portfolio since it's limited to only one sector, but it's been very fun, if not a wild, crazy ride, to follow. Since this portfolio started, it has outperformed the two dividend portfolios over the same time period, but with a huge amount of volatility. The portfolio did particularly well last week and over the past 2 weeks. Last week, the portfolio jumped 4.63%, and over the last 2 weeks, it was up a crazy 11.11%. Now, it's also had some crazy down weeks, so don't think it's just all up, up, up. This portfolio has been very volatile, once again showing the advantage of lower volatility strategies, such as dividend investing, for those that can't stomach such large swings up and down. So how is this portfolio different from the $1,000 tech-themed portfolio shown on the previous slide? The portfolio on the previous slide is based on certain technology themes and therefore includes some stocks that are not technically in the tech sector, like Google, Amazon, and Meta. So on this slide, I rate the top stocks for the week, but they must be in the technology sector. The average investment so far has been held for 107 days and has produced an average total return of 16.59%. Using Excel's rate function, that's a 68.88% annualized return. If we'd instead invested our weekly investment into the tech ETF called XLK, instead of a 16.59% average, we would have an 8.33% average with the same holding period, obviously, which is 31.4% annualized. I'll be very curious to see what this portfolio will have done after a full year of being in existence. The portfolio is also outperforming the S&P 500, but remember the volatility of this portfolio is very high, so it's not for the faint of heart. Note that all these stocks are higher quality, meaning they must have a quality ranking of B- or better. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend-growth stocks, because many tech stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc. But we use the valuation methodology we discuss in class that can be used on all large stocks, whether they pay a dividend or not. Now, if you look at this list, many of these companies do pay a dividend. So Broadcom pays one, Lam Research, Microsoft, Applied Materials. Adobe and NICE do not. KLA Tencor does pay a dividend. Taiwan Semi, Intuit, and ASML. So all of them pay a dividend except for Adobe and NICE, which I find to be interesting. So the four top stocks, according to our ranking last week, were Broadcom, Lam Research, Microsoft, and Applied Materials. Of course, we bought all 10 with our weekly investment. All right, so in the comments, let me know if you have any questions, and also let me know what other kind of investing videos you'd like to see. And if you're a subscriber to my website, beatthestockmarket.com, and you'd like to see the tech stock portfolio on our website, let me know. Could be a fun project for me over the Christmas break. And finally, here are the places you can reach me. YouTube, obviously, as well as my website, beatthestockmarket.com, LinkedIn, and Twitter. Remember, you can now find both the Dividend-Growth stock portfolio and the high-yield stock portfolio on the website with real-time transaction data on Mondays when we make our weekly investments and anytime we sell a stock, as well as information about our portfolio holdings, complete holdings. So I will see you next week. Bye.